Hello and welcome to another episode of the SwingTrader Status Update. This is our weekly show that we do every Tuesday live on YouTube, starting at 5. So here we are. It's January 21st, 2025. We have the inauguration behind us, another successful transition of power in our nation, and we've got a market that had what looked like a follow-through day on Friday. Not that we needed it, but we'll get into more of that. But let's bring on Mike Webster, who joins me every week, and walk through and see what's happening in the market. How you doing, Mike?
Good. It's always nice to have an extra day over the weekend, so bring more of those.
What was it a day of rest though?
No,
Was it a
I,
day
I
of
worked.
rest?
I was working all day, but it's
Right,
okay.
exactly.
I was. I looked at thousands and thousands of charts,
Yeah.
but that's what I do.
Yeah,
What are
I
you
was
gonna
I was on a flight myself, so it was nice to have that day to fly back from Mark Minervini's birthday bash, which was absolutely incredible. I really enjoyed meeting a lot of IBD folks actually at the gala event that he had, and also his birthday. And man, that guy on the drums is something to behold. So
I saw the videos. I was so envious. I wish I could have gone, but there was just no way for me to get out of here. But man, I miss a great time. Hopefully, he does a 61st birthday
right,
bash.
exactly. Yeah.
I'll be
Uh,
I'll be there.
Perfect. Well, let's get into some market charts. I suppose we can start with the Nasdaq.
Sure.
Although the Nasdaq, it seems like it's kind of losing its favored index status right now. The relative strength has been a little bit lackluster lately. It's back above the 50-day moving average line, back above the 21-day moving average line. We really kind of made some nice progress in that regard, jumping up low, jumping above both of those moving averages on Friday. Nice follow up today, even though it was an outside day, kind of testing some of the lows of Friday. It really closed well.
Yeah, and Friday's action looks not that good on the chart if you because it's this tiny little spread, closing mid-range on there. But yes, you read my mind. If you look at the full bar from the close from the prior day, that's night and day. Like that was that was a powerful day, and as you said at the top, that was a follow through day. Not that we were looking for one. I think if Bill was around, he would have been looking for one. But with our market school rules, we just since the power
We
trend
didn't
was
need
still
one.
on,
We
yeah,
can
we
always
didn't
look
need
for
one.
one, but we didn't need one.
That's well put. But anyways, I will spare all the lyrics that I was going to go into right there. But so the bottom, if you can mark to the pink rally day, which is the bottom on there, and that is day one. And even though it wasn't up on the day, that's your rally day because it closed in the upper half of the range, and that was your lowest point. And then looking for a follow through is day 4 or after. I believe Friday was what, day 5.
Day
So that's
5, right?
normal. Normal. You lots of them, not all of them, but lots of them happen between like the 4th and the 10th day. But you and I, and along with Charles, when we were doing all that work for market school, I mean, we were finding some like in the 20s, right? Wasn't there
Yeah.
like 28th day follow through and such? So that's one of the reasons why I lean so heavily on the 21 day, because there are going to be times where just the way the data falls that you're just not going to get one. But if you're in an uptrend, you're going to get over the 21 day. So we have both of those things happening. And so this actually looks like, let's clean this chart up for a second, just refresh it and draw a declining tops line over this little bit here. And, this looks like it, depending on how you draw it, there's an art to it, but, I like the way you drew it. This is in the spirit of a setup day. Typically, a setup day would have a smaller spread than what we had today, but it gives you this expectation that it wants to rip up to, 20,000, in short order. So this looks, and that area there, which if you looked at this as a double or a triple bottom, depending on how you want to look at it, that's kind of the middle of that area. So that would be another um, way to get through it. On Friday's SMT, I was on with Ed because you bailed on us. Frankly, you were off partying.
Right.
And Allie
Priorities.
Poor Allie was sick and you're partying. So Ed had to do it with me. We had a good time. And I was talking about how this is three waves down was very similar to, like the three waves down we had last year, or I mean the prior year. If you can unscrunch this, you can maybe we can see the three waves down that we
I
had.
I'm afraid to unscrunch it just because
Oh,
if I mess with the resolution, then I
then
might break things.
don't worry about it. So, three waves down is something that happens a lot, and yeah, you probably just can't see it. Don't worry about it. So, anyways, the it's where you have one bottom, shakes out a lot of people, tries to go up, fails, has another bottom, shakes out, and then by the third time, it's gotten everyone out of there and it's kind of cleaned house, and then the market is ready to go. And that's how I'm viewing our current market is that we've had three waves down, just a lot shorter than what we're used to. Typically, that happens over months, not just just weeks in there. Now let's go over to the SPY for a second. And as you were saying, SPY actually looks healthier than the Nasdaq right now. We clearly broke that downtrend within this declining tops on there. We broke through it on Friday, and now we just built on that. And frankly, on Friday, I thought we were going to get over 600, and we didn't get there. So I was a little concerned that it was, even though it was a strong day Friday, that was didn't meet my expectations. I thought they would push it up over 600 going into a 3-day weekend. They didn't, but now we got it above it now. I think our next stop is at 609.07. I think we go up through there. That's what the market is telling us now. As we were talking about pre-show, we are just at the very beginning. First couple of innings of earnings season. So we're going to get a lot of volatility, hopefully on the good side. But we both know we've been around the block enough to know that we're going to get some big gap downs. That's going to be a drag on the market. We had some stocks that were a drag on the market today, like Apple.
Mhm.
Is a big market cap. Obviously, it's in all the important indexes. Now that closed up off the lows and it looks like it's trying to get support around the 200 day. So hopefully this is the bottom of a base, or it's trying to bottom out here. But when you're underneath your 50 day and your 21 is crossing through your 50 day, it's not a really good position. And that's fine. You don't have to have every last stock. Let's take a look at Microsoft.
Yeah, and just
Um,
before we move on there, it's worth
sure.
noting this really poor looking relative strength line.
Yeah.
Um,
And, same thing here. This one has just been out of favor, and that's fine. You don't have to have everything always um, going up, because this allows when everything that's moved up pauses, maybe these things kind of take the baton as they're just base building. So I bring that up because there's more potential upside
mhm.
with these. And then Google was looking like it wants to go, hasn't gone yet. Is trying to go today and kind of backed away, and Meta's kind of just base building. So
And
you've got a
I do
lot
have
of
a position in Alphabet. I actually reduced it a little bit just because of the way it closed, but I have a gain on this from from previously. So,
okay. Well, good for
and you know
you.
what? Just real quick, I want to
Yeah.
bring up FNGS too, because I mean this certainly doesn't look broken by any means,
No.
but it's not as it's not the one that's doing the heavy lifting now.
Well, the
You
one
compare
that's doing
that
the
to
heavy
RSP.
lifting is, yes, you read my mind. It's like everything else is doing the heavy lifting, which is RSP.
Yeah.
That looks beautiful. And, shame on me. We were talking about putting that on the list when it got support at the 200 day and had that upside reversal. But we were both like, God, if there was a
If there was a
2X,
leveraged,
yeah,
right. It would have been
but
a no-brainer. Yeah.
yeah, look at that RS line, on 500 stocks that are equally weighted to have a RS line like that. Like, I don't want to hear anyone, talk about poor breath, like
Not
this.
anymore. I look, you
Yeah.
could make that argument before, but it certainly has been a shift. And look, at the time you said it, like, oh, this would be a great trade, but a short-term one, right?
Yeah.
It's like one of those things you don't expect to have a huge gain, which is why it was like unless there's a leveraged why would we kind of, put it on for what would be probably a shorter and smaller gain?
Yeah, and I did have some RSP, and I sold it today just to lock it in, just to really to use those proceeds for other things that were faster, because it seemed like that was the bulk of what you were going to get here. And now, if you've looked at enough charts, you can just visualize the right side of this just moving up to the 188, and that's normal and natural. And now that it got above its 50-day, it might back and fill a little bit here. We'll see, but you can't ask for more than that. RSP going up day after day after day, closing at the highs today. Yeah, that's telling you that the market is a lot healthier than I think most people think. I believe there's a lot of fear in the market still. Now, I don't use any secondary indicators at all, as far as like bull, bear, put to call, VIX, any of that stuff. And I don't use
We
any of
have
that.
them. They're
Yeah.
available,
Yeah.
on Market Surge, NYEXG or NASDQ are, two areas that kind of show market indicators. And you can see that, you know, new highs have been lower than new lows for a while, but it looks like it, maybe it can change here. Advanced decline lines, if you look at GMIIAA, which is the advanced decline line for NYSE, or if you look at GMI AB, which is the advanced decline line for the NASDAQ. NASDAQ especially a little bit more poor, but it's been like that for a while, and we've still had the index going up.
Yeah, I think all of those have various problems, and why I don't look at them at all. I used to look at them religiously back in the 90s, but yeah, they all have different problems. That's a topic for a different day. So, just moving back to the market, it looks set up, but we always take things one day at a time. The low being above the 21 day now for a couple days. That's really good for market school. Of course, we use 5 days, but I think 3 days is, if you and I were to go back and redo market school, which we probably should, but we just need the time. I think we would change it to 3 days from the current 5 days. So it's things look good, but you always, when things look good and you're in the middle of earnings season and you have a new president in there, you do have to still take it one day at a time. I mean, yesterday, as Trump was signing the all the executive orders, he made a comment about the tariffs on Mexico and in Canada, and all of a sudden the futures just fell like a rock. And it's like,
Mhm.
we just have to, we've been here before. We had that for 4 years. That's what we're going to have for another 4 years. He's going to be, just making comments. People ask him questions, and he's just going to be talking off the cuff, and the algos are going to run with that. And so you just have to have, that's not good. It's not bad. It is just what it is. And so you have to realize that with your stops, if you got a bunch of tight stops, they're going to be triggered at times whenever he's talking. So,
Yeah.
um,
And again, it reminds me a little bit of 2017. There was, and we talked about this a little bit, there was sector rotation under the surface of 2017, but overall, it looked, if you looked at the indexes, it looked like an easy, easy
yeah, it
market to
wasn't, that
trade,
wasn't,
right?
yeah, yeah,
I mean, the biggest, I think correction on the S&P 500 was like 3.4%. So it looked like the easiest trade in the world. And look, you had the Russell 2000 that led at first, infrastructure, all of these things that, the expectation was going to be that was going to happen. And then it kind of shifted to other things, expectations shifted. So again, the indexes did great, but what sectors were in favor really changed, quite a bit. And there was that volatility under the surface.
yeah. And that's one of the reasons why we put SSO on SwingTrader, was to capture that one, what the market was doing. And I do have a position in
I
in
have a
in
position in this
in,
as
in
well.
spy related instruments. And this, you know, there's a time to have a position and a time not. I do have some cues, but like you were saying, the personally, we didn't put it on SwingTrader just because that RS line wasn't there, and we were going back and forth on whether we were going to put it on or not. Instead, we went with the ARKK, which I do have a position in as well,
As do
because
I. Mhm.
frankly, all of her funds, Kathy Wood's funds, look really good, and I've got various size positions in all of them, and that's where the heat is, and that's where the relative strength is at this moment in time. And while this was up there a bit, up 3% on the day, but you can see the declining tops line that it was just breaking through. So this was really your breakout. There wasn't a clear entry before that, unless you're using that upside reversal down that was underneath the 50-day. So that would have
Mhm.
been a hard buy in the way we do things.
Mhm.
But I can see people buying it there. But this looks like where it should launch higher. Now that she has some other funds, people should look at them. We weren't going to put all of them on Swing Trader, but I think the other ones look interesting as well. It's worth looking at the holdings in there to kind of get a sense for. It's a lot different than the things that we trade. Some of the stuff is junk, and some of it's quality. There's a blend in there, and there is a benefit to having an ETF, because if the heat's going in there and you want to participate there, but you don't want to go and have that individual risk, this is why I like going in that space.
Yeah. And, look, a lot of people look at ARK-K and, the ARK Innovation Fund and, look at this big downturn and, the risk management and all of that, Kathy Woods. But I wrote an article a couple weeks ago about, look, you know, is it her job to do that risk management? She's got a mandate, for her ETF. We as individual investors, we can manage the risk and not sit through this. Her mandate is not to be in cash. That's ETFs don't like doing that. That's not what they're designed for, right? So
Yeah, she's doing exactly what she should be doing. I have a lot of
mm,
respect for her, and her willingness to not change her style in any material way. Maybe some nuances here, but she didn't like switch from this and go into, Coca-Cola and Johnson and
right.
Johnson. Like
We're gonna
she
trade the staples.
yeah, so she kept what she's doing. So it's like you said, it's on us to trade it when that stuff is in favor, and then move out of it
Mhm.
when it's not. And if you don't want to trade those, no worries. You don't
Yeah.
have to.
You know what? I want to shift gears and talk real quick about our pie chart because, again, we have really kind of shifted. Last week, as we were discussing this, look, it was right before the CPI report. So we were actually a little bit more invested than we wanted to be.
Yeah.
We were like, oh, I think we were 76% invested, 3% invested. And it was like, okay, well, cross your fingers if the CPI report doesn't go well, we're going to take a hit, but we still had some cash. So that would soften the blow a little bit. But we were pretty well spread out in a lot of different areas, and that remains to be the case. The only difference here is we don't have a cash position anymore. We're actually slightly on margin. We actually came down in exposure a little bit just by nature of taking profits on a lot of things. We're shifting our strategy this year, and we're going to really kind of focus a lot more back to the basics that we were doing in 2020, shifting from kind of a shotgun approach to a lot of stocks and adding, you know, that's hard for people with full-time jobs. So we're going more towards larger positions to start. We're going to be trimming them as soon as we get some strength. We're going to be trimming them a little bit quicker if they don't move, because we can't afford to let a full position go. So there's going to be some time restrictions. If it doesn't do a certain thing by a certain time, out it goes. I don't know if you call that a time stop as opposed to a stop loss.
Yeah, it's a dead
Um,
money stop is what I
yeah,
call
dead
it.
money stop, right?
Yeah.
But
So the thought process in general is, we're like you were saying, we listen to everyone's feedback, and the shotgun approach that we were doing last year was frankly a watered down version of my shotgun approach. Like, we couldn't do everything that I do. And so that caused problems, because we were already putting out so many alerts that if we did it the way I would do it, we would have had like 3 or 4 times as many alerts as we were putting out there. And we just realized that most of the people that are taking Swing Trader aren't full time sitting in front of their PC all day. It's people that are professionals, or you have a life. You're not glued to your desk like both of us are, as well as Dominic, all day long. So we wanted to just make it easier for people to follow. Also, I was getting a lot of comments like, I'm just trying to understand what it is that you're doing. And I realized that people weren't getting it. And so we wanted to make it more predictable. So
Mhm.
basically, we're going to put on the same size position each time. In almost all cases, there'll be exceptions. But right now, we're doing full size positions. Now, if we get into a point where we're living underneath our 50-day on the NASDAQ, or the S&P, or God forbid, underneath the 200, we might start everything off with half percent positions, or half positions, which is a 5%, or a quarter, which is 2.5%. But right now we're starting everything out with a full 10% position, rather than before we were going some at three halves, which were 15%, all the way to starting some things off at 2.5. That was confusing to people. So we're making it easier, not necessarily better, just different, easier to follow. Then as they go up, half an ATR to 0.75, or a full ATR, we're going to be taking some off, a quarter into that, on the second day, typically not on the same day that we put it on. Then on the third day, if we're showing even more progress, we'll take another quarter, and then we're going to kind of let that half um, just sit there and bake, and see if it can run. So again, we'll start off with a 10% position. Into strength, we'll bring it down to a 7.5. Into some more strength, we'll bring it to a half. And then we're going to let it sit there. And then we have our time stop on there, where we're slowly raising up our like our hard stop of where we're going to throw in the towel on it. So that way, if it's not making progress, out it's going to go, with a dead money stop. If it's just sitting there and it's not moving, it's not really doing anything wrong, but it's money at risk. That's what I consider dead money. And so we'll just close the position at that point, be willing to buy it back. And hopefully people have picked up on that new strategy. It pretty much happened right around the beginning of the year. And I'm happy with it. It's a lot easier to follow, I think, for people. And, and we'll see how this goes. We're going to adjust as we get feedback from the market, of how it's doing, where we need to make adjustments. And then also, we want everyone to be able to follow. We're not doing all this work for fun. We're doing it to help people. So that's our goal.
So here's an example of that. We had CF Industries on. I actually, bought a position along with everyone else, or I guess 30 minutes after, and had a nice move that first day. We were taking some profit on this day, and it just wasn't moving on a follow through day, where everything was looking so strong. This just wasn't moving, and so we took our profits and exited. Wix today, we took this one off. It was an outside day closing at the lows. We had put it on, as it was moving above this area, the kind of breaking out. Took some profits. You know, we were already down to half a position as we were taking profits into the strength, and just okay, we've had 3 days not doing anything wrong, but just kind of not moving in the direction we wanted to see. So just locking in those profits a little bit quicker.
Yeah, and so like with the Wix, for example, if people were bought it when we bought it and wanted to sit with it and just say, "Hey, I want to turn this into a position trade," as long as you're still up on it, nothing wrong with that. We're just also using that money to put it in other stocks, or ETFs. And so that's a dead money type of thing. It's just something is, and that's how I've traded since the 90s. If something is just sitting there and it's at risk, and the market's either wobbly, or, which wasn't the case today, or there is better merchandise to put it into, just rotate it over there. If this one came down a day or two and had an upside reversal, we might put it back on.
hmm Now, let's also talk about United Airlines. I do have a position in this myself.
So do I.
I believe you do as well.
Yep.
So, like like we kind of introduced last year, there might be some cases where if we have enough profit, we'll hold on to something. Before that was like a no go. We're not holding anything on into earnings. But if we've been locking in some profit on the way up, as we have with United Airlines, we're up over 10% on the trade as of today's close, and we knew that earnings were coming up, so we scale this back to a quarter position. And in doing the math, okay, if the market maker move, I think was roughly 10 points. So if it came down a full 10 points, the we would have still gotten out of this trade at roughly a 5.8% gain for the trade. As it stood, we were up about like maybe 8.6% for the trade. Now that we're getting a little bit of a gain on this, that's going to put us closer to 10% for the trade. Now we have a smaller position, only a quarter, so we weren't risking as much going into this earnings event, but we haven't lost our foothold in this trade either. So it's up about 3.4%. So again, you don't have to follow us exactly, but we do. If we wanted to add those shares back, we could. So
Yeah, I added to mine in
Mhm.
after hours after the earnings came out and that risk was behind us. I added to it and we might add to it tomorrow. Just depends on where it opens. There was some weakness in the travel space. We were talking about it beforehand. I'm not sure what was going on with booking, and I think you mentioned Expedia as well. So in the cruise lines, sold off a bit during the day, which was a little. I do have some RCL and Viking, and so even though they're not directly the same thing, it's in that same travel space. We just want to see how it trades tomorrow, because sometimes when a company reports after hours it's up and then they say something on the conference call, or the next morning some analysts find some nitpicky thing in there and they downgrade it, and then it comes in. So we'll see how it is tomorrow. We might add to it, we might just keep that quarter position, but we'll probably do this more, but as we go forward, but probably only holding a quarter or uh,
Mhm.
a half position into those earnings, just because of the risk. And this is swing trader. It's not leaderboard. Leaderboard, if they want to go into earnings with a full position, they can. It's that style, or they can hedge it with options. But that's just not really what we're doing right now. We're trying to keep it as simple as possible. That's subject to change, but yeah. So
Yeah.
I'm happy with how this turned out. This is kind of a model of what we'd like to see happen. Is where we put it on as a full, we trim it into strength, we trim some right before earnings, got at the pop on the earnings, but would have been fine too if it was down as much as it's up right now. We would have just backed away from that quarter tomorrow.
Yeah, and again, it really we would have still left because of our trimming into strength. We took our first trim at only up like a couple percent,
Mhm.
and then we were trimming when we had a 10% gain, and then again we trimmed a little bit today, still up 10%, over 10% from our entry with yeah a lot of cushion there. So that helped. I'm showing right now where our entry was. So again, a nice cushion. Look, we held through this because it was closing in the upper part of its range, and
And because we had taken some into strength,
yeah, exactly.
taking some into strength is, a style that, I used to do in the 90s, and we did it in, the 2019, 2020 when we were doing this together. And it's a style to go with. It's not necessarily the only style
Yeah.
of swing trading, but it is a style that I think is a lot easier for people to follow. And plus, it does get that benefit. Once you lock some in, even a little bit with a tiny gain, if you run through the math on there, it just is a lot easier to have good performance that way. It's
Mhm.
a complete opposite of starting off small and shotgunning and pyramiding in. That has its strengths, but you have to be extremely active with that, because you have to do all of it. If you have a system and you do 75% of it, well, that 25% is going to be a problem. And that's really in our post analysis of last year what I think the issue was. And so I think this is going to play out nicely.
Yeah. And just to address a question that Gary had in the YouTube comments, he's like, does it make sense to hold a little more into earnings given the strength of the market right now? You can absolutely do that. We were actually going back and forth on that idea. I think if we had held a half, it would have been fine. We did the calculations. We still would have come out with, with just under a 5% gain on the trade if it had come down 10 points, which again, that's a significant move. If it had come down 10 points, that's a big loss. Even if we had, come down to break even after having a 10% gain, we still would have done okay on the trade because we had taken the profits into strength. So yeah, depending on where exactly you got out and what your risk tolerance is, and how the rest of your um, you know action is looking in your portfolio, that's something that you can certainly be doing.
And one
um,
one last thing I'd add on to that, and let's go to the weekly. You would want to rate your stock as well. So if you, I rate my stocks A through F, and I rate this as an A, almost an A plus, but an A because of the powerful flag that it had in this. I'm looking at this as a high tide flag, that moved up from the 40 to $50 range up to 100 and held in tight and then broke out and held in tight. Like that is perfect action. And so this was an A. And yeah, we were going back and forth on just holding the half, but we just erred on the side of safety of reducing it. But yeah, I think with this, you're fine holding a bigger position. But if it was a B or a C caliber stock, maybe you just blow out the full position before earnings so you don't take that gap risk.
mhm. Um, And let's see. Let's also take a look at something that has a pretty low ATR. BSX. This is in the medical space. Again, just showing how broad the areas are of what's working. Um, this is something that we put on. We immediately got a nice gain on this. Pulled back a little bit, and so yeah, this is another one where we took some off into strength. But it's been a nice a nice steady gainer for something that has a pretty low ATR.
Yeah, and I've got a position in it that that I bought after we put it on the list, and
I
it's
sold my position and I forgot to buy it back.
yeah, that happens to me all the time, man. Way more often than it should.
Wah
But
wah wah.
it now that it went through its 100 level, even though it's down a little in after hours, that's the old Livermore number. And if you don't know what I mean by the Livermore number, go get Reminiscence of a Stock Operator. Um, Probably the best book, along with How to Trade in Stocks by Jesse Livermore. Those two are my favorites, and of course, Bill's. But when it goes through a round number like that, the assumption is you're going to get a quick move a lot higher. It's whether it's $50, $100, $200, $300. These round numbers that people have been obsessed with for over 100 years, and it works. So if this starts backing away around $100, we might trim it or exit it and just lock in this position, because when you get to 100, you should really uh, push past it. One that I was looking at that we might do something with tomorrow, Spotify, that I think is having a good reaction to what was to the Netflix numbers that came out. That I did buy some of that in the after hours, but this was set up. It looks like it wants to go through 500. Whenever you're around a round number like that, that can be powerful. Now we've tried this a million times. Some of them have worked out, some of them haven't. But it does look set up that it wants to go. So those are the things that you should be looking for. Things that are right around round numbers that have a pivot in that general area, and it just gives you a little bit more confidence to put on the trade.
Yeah, and just as an example, I do kind of trade a little bit differently in my Thinkorswim account. I trade faster and more of a swing trader type. In my Fidelity account, I do hold things a little bit longer. So Spotify is something that I do currently own in that Fidelity account because I have a gain. I was actually able to hold through, this recent correction, and when we sold it on SwingTrader, I was able to hold on to it in this case. So,
So that's your Axel account?
exactly right. Anything to kind of wrap things up here?
Um, let's go back to the RSP for a second, just to kind of finish things
I'm
up.
also going to look at any YouTube comments that we should, a few folks. Oh, someone said that they took a pic with me. So, hey, post that on Twitter if you don't mind. I'd love to see that, Cat. The picture you took. Took a lot of pictures with folks at the Minervini event. That was awesome. Gosh, some people are talking about how cold it is.
Dude,
Especially.
I've got snow out there. I'm sitting here freezing. We've got snow outside, and for whatever reason, the only room in the house that doesn't get too warm is my office, man. I was like, uh, but with the RSP, I would just say that even though it would be normal for it to pull back for a day or two because it's gone straight up from the bottom here, the I would step back from it and let's go to the weekly and just envision what the right side of it's kind of, go ahead and do the best fit, even though I hate it.
Oh, that's a rare thing.
I know. Um, but just picture in your mind what this would look like and how much time it would take out the right side. So if it goes even faster than what it should, and it should to get back up to the 190, the high 180 area, close to 190, that should take a few weeks. It
Mhm.
shouldn't happen in a week. That would be very, very unusual. Maybe even a month to go out there. Goes any faster, then the market's even stronger than what we think, because this is a good clean measure of breadth of the market, just because it is 500 stocks equally weighted. And let's go back to SPY for a second on the daily. And this is what recoveries look like before they launch a lot higher. Like if the two of us, along with Charles, we did so much work with the market school rules of just studying the market. We just studied that fishbowl over and over and over again, and this is what they look like. Imagine this is 620, and you'd go back and say, where would you want to start pressing the gas? It would be now. This is where you start doing that. And so that's why we're slightly on margin. We might go in deeper. Frankly, I wanted to go in deeper today, but I was struggling to find individual stocks in position. They were either we like to not put things on if they're within 10 days of a earnings. So that got rid of a lot of things. We're not putting on super high ATR stocks right now. That cut out a bunch of things. And then the rest of them were pretty much up and out of there. That's why we had to start going towards, we had to add ETFs today rather than individual stocks, just because everything that looked good was just a little bit too far out of there. So there's a lot to pick from.
Yeah.
This is a time to do a lot of work, man.
Right. So, and again, for those of you that are SwingTrader subscribers, you're going to be seeing those alerts, the updates to the market commentary to kind of help guide you. So, plus, if you missed it, make sure to check out on Thursday. Mike and I did a webinar along with Scott St. Clair, kind of talking a little bit about our strategy and kind of an introduction to swing trading. So that's something that definitely check out. You can go to investors.com/webinars, I believe, and you can see the recorded webinar there. So hope you check that out. And
Oh,
hey,
one more thing did want to add is that, for anyone who ever wanted to build a model book, I did this weekend. It was a 3-day weekend. I had a little extra time, didn't really, but decided to do a little video, and I put it on Twitter of how I build model books. So my handle is mwebster1971. It's my pinned tweet. So you can watch that as you have time. But this is when you should really be studying models. I think you should spend at least a half an hour to 45 minutes a week building and studying models. And I'll walk through at least the basics of how to do that. So hopefully that helps out. I don't think we've done a video like that before. So hopefully
yeah.
you enjoy.
And you know what? Evan was saying, oh, you're note on volatility, staying away from some of the higher volatility names. They were saying, oh, so no Oklo today.
Well,
Well,
indirectly,
kind of. We snuck into NLR, which is an ETF. So it was up 4.9%. I do have a position in
so do
NLR as
I.
well. I bought that 30 minutes after our restriction period when we put it on. So yeah, we're getting access to some of those higher volatility names like what you would find in NLR and ARKK. We're just doing it in ETF to kind of squash that ATR, the average true range, down a little bit. And the average true range is something that we did talk about in that webinar. So on that note, now we're done. Thank you so much, Mike, for all your wisdom that you're sharing. And that's going to wrap it up for us. Stay tuned, and we will see you all next week. And also, if you want to check out the podcast tomorrow, I've got Nancy Tangler on. She's a new guest. She's from Laffer Tangler. She's going to talk about some of the things that she does for a long-term investment. So if you kind of do some short-term and some long-term, Nancy Tangler might have some of the things covered for you on the long-term side. So check that out. It's going to be tomorrow at 5 o'clock Eastern time, right here on the YouTube channel of investors.com. We'll see you then. Take care, everybody.